Picture the safest paper in finance, an invoice, money a real company already owes for goods it already delivered. Around $10 billion sat inside 4 funds built on exactly that idea at Credit Suisse. This June, the man behind them agreed to a 9-year ban from ever running a UK company again. But here's the strange part. Regulators found the funds hadn't just been holding invoices, they'd been holding bets on invoices that didn't exist yet. And the bank barely knew. This is the hindsight. To understand how an invoice became a bet, we have to go back to 2011 and a farmer's son from rural Australia who thought he'd found a better way to pay suppliers. That farmer's son is the reason $10 billion ended up in those 4 funds. His name is Lex Greensill. His family grew sugarcane and melons in Bundaberg, Australia. Growing up, he watched something that stuck with him. Big retailers took months to pay small farmers, while the farmer's own bills came due immediately. How do you fix that gap without the farmer going broke waiting? Here's the fix he landed on. Imagine you're a supplier. A big customer buys your goods, but won't pay for 90 days. Someone else steps in, hands you the cash today, minus a small fee, and collects the full amount from the customer later. That's supply chain finance. It isn't new. Banks have done small versions of it for decades. What's real, what's already owed, gets paid a little early. Lex Greensill's idea was to do that at massive scale, digitally, for the world's biggest companies. He founded Greensill Capital in 2011. By 2017, he'd found the partner to fund it at scale. Credit Suisse agreed to package these invoices into investment funds and sell them to pension funds and insurers as one of the safest things money could buy. Short-term, backed by debts that already existed. Practically riskless. That was the pitch. Pension funds and insurers signed up for exactly that reason. They weren't looking for a bet, they were looking for something boring and dependable. Keep one thing in mind as we go. This isn't really a story about invoices. It's a story about who agreed to stop checking them. So, how do you go from paying farmers a few days early to running a multi-billion-dollar financial empire? Fast. That's how. By 2018, Greensill Capital was processing over $140 billion a year in transactions. SoftBank's Vision Fund poured in more than $1.5 billion. David Cameron, the former British Prime Minister, joined as an advisor and began pitching world leaders on the company's behalf. Lex Greensill was preparing an IPO that some bankers valued the company at over $7 billion. It wasn't only suppliers who liked the deal. The big buyers liked it too. It let them stretch out their own payment terms without technically hurting the people they owed, which meant more companies signing on, more invoices flowing through the machine, more reasons for investors to believe this wasn't a fintech experiment anymore. It had become infrastructure, as essential and supposedly as safe as a bank. Now, think about what that growth actually required. Supply chain finance only works if there's a real invoice behind every dollar, a real buyer, a real delivery, a real 90-day clock. To keep growing at that pace, Greensill needed an endless supply of exactly that kind of asset. How do you keep feeding a $140 billion a year machine with something as finite as real already owed debt? You either slow down or you find more supply somewhere. And here's the part almost nobody focused on at the time. The supply started running short. So, the definition of what counted as an eligible invoice quietly started to stretch. Here's where the story stops being about invoices you can already see and starts being about invoices that don't exist yet. Think about it like this. Paying a supplier early against a delivery that already happened is one thing. That's the melons already picked, already sold, already owed. Now, imagine instead your financier starts paying you today for melons you're expecting to grow next season based on a forecast, not a receipt. No delivery yet, no buyer confirmation yet, just an estimate of what might be owed someday if the sale goes through. That's what regulators mean by potential future receivables. Here's how it actually worked, mechanically. Greensill packaged these claims, the real ones and the forecasted ones, into securities. Credit Suisse bought those securities into its funds, then sold shares in the funds to pension funds, insurers, and wealth management clients around the world. And at every step in that chain, who was actually checking whether a given claim was real? Not Credit Suisse. Picking which claims went in, reviewing them, pricing the risk, that stayed with Greensill. The company that originated the assets was also, in practice, grading its own homework. Why would anyone let that into a fund marketed as low risk? Because almost nobody outside the fund was positioned to say no. This is in the public record from Switzerland's financial regulator, and almost nobody has read it. Credit Suisse had little knowledge or control over the individual claims inside its own funds. Selecting them, reviewing them, insuring them, all of that was left to Greensill. The bank that sold you low risk wasn't the one checking what was actually inside the box. And that's the moment this stops being a story about invoices and starts being a story about who was supposed to be looking and wasn't. And then it gets worse. The warnings weren't invisible. In 2018, another fund provider quietly stopped working with Greensill. Questions followed inside Credit Suisse. They didn't lead to an exit. They led to a bridge loan instead. Greensill wanted financing to help fund its own planned IPO. According to Swiss regulators, an internal Credit Suisse risk manager recommended against it. And then what happened? Senior management overruled the recommendation. The loan went ahead. 2 years later, in 2020, one of Greensill's biggest clients, a construction tech company called Catera, was running out of money. Transactions tied to Catera stripped away legal protections that a Credit Suisse fund's investment had relied on. $440 million came into GCUK around that time, money that was supposed to go straight back to investors, redeeming their notes. It didn't. The UK's insolvency service later established where that money should have gone. Not where it actually went, just where it was supposed to go, and didn't. This is public too. The administrator's report, the disqualification filing, together they lay out a specific sequence. Not a mystery, a paper trail. By the time an insurer finally pulled its cover from the funds in March 2021, the foundation underneath had already been hollowed out for months. Credit Suisse closed all 4 funds on March 1st. 1 week later, Greensill Capital's UK arm collapsed into administration. Roughly $10 billion. Money that had been marketed, fund document by fund document, year after year, as low risk, now sitting in administration, its recovery still being worked out. 2 years after that, in February 2023, Switzerland's regulator concluded that Credit Suisse had seriously breached its supervisory duties in the entire relationship. This June, 2026, Lex Greensill agreed to a 9-year disqualification from running any UK company, not a criminal conviction, a civil undertaking, following an insolvency service investigation into decisions like the Catera transactions. It's tempting to file that away as the ending. The bad actor finally held to account. But remember the risk manager, the one who said no to the bridge loan and got overruled anyway. That's the part of this story that actually explains it. Nobody involved thought they were doing something reckless. A profitable relationship, a trusted partner, a label that had said low risk for years. All of that made it easier to stop looking closely, not harder. That's not a Credit Suisse problem or a Greensill problem. It's what happens almost every time when the people paid to verify a system would rather trust it. If this is the kind of story you come here for, subscribe. There's a new one every week.